Our second trade didn't go as good as the first. We won $3 on the first trade and we lost $5 on the second. Hello, I am Robert and welcome to my channel. Let's get into lazy trading. The second trade, which I mapped out on the screen so we can discuss some of the issues behind it, really was an interesting trade because it showed and it demonstrated the power of the stop loss. Stop losses cannot be underestimated. They are incredibly important because they work well in doing exactly what they're supposed to do, stopping losses. As I mentioned in my last video, they aren't instant, but like applying a brake in a car. So as we can see, we took a loss of $5.24. So we had our $3 profit and then a loss of $5. That leaves our main account at $997. That's actually very good and really demonstrates one of the most important factors that must exist at all times: risk management. Let's see if I can spell this right. Risk management is one of the most critical aspects of trading. If you can learn that, nothing else really matters. Because once you know how to manage your risk, even flipping a coin can be a profitable strategy. It's not necessarily a wise strategy, but it can be a profitable strategy. That really is the entire point of trading. Everything else is just a tool to help you find the best positions. Managing your risk is the most important part of the entire process. Nothing, and I mean nothing, is more important than this. But this is why lazy trading works. Because this is the only thing you really have to learn. So let's look at the chart and really get into the details of what risk management is and why it's so important. I have zoomed in the chart where we can see exactly the candle and the trade we are talking about. For the blue line, I made this where I placed the original trade, where I made the initial purchase. The green line was my $3 take profit. The red line was my $5 stop loss. I did this yesterday over the weekend because I had a feeling the market would probably sell off the position, and I wanted to be able to demonstrate the significance of this situation. Now, from the standpoint of what we are looking at with the stop loss, we can clearly see by today's candle that there has been a huge amount of buying in the candle and the price has gone up. But we can also see that there's been a huge pushback from these sellers, keeping the price away from the highest point so far of the day. If we go to lower time frames and actually look at the candle in a different point of view, when we look at today, we can see these lines represent the weekend. We can see that big push, that big, huge drive that pushed price over our stop loss. This is the important part of understanding the dynamics of the market. From the standpoint of the market, a stop loss isn't really a lazy tool. It's a precision tool. When you use a stop loss, you need to be careful about your entry because it will do just what it did in this example. As we continue to look at the market from the open, we can see what many people call resistance. That is, the price hasn't been able to get above a certain point. This is not an absolute zone or an absolute precise number. This is just a region where the market doesn't have the strength because these sellers aren't willing to accept the price that high. So they are resisting the buyers. That is really the entire point of what resistance is in terms of trading. A zone or region where buyers and sellers push price to acceptable limits from both sides. Buyers always want higher prices. Sellers always want to drive the prices down to a fair market value. So this resistance that we see on the screen, where when we look particularly at this section here, the three candles that have a very similar line of price action, we can see that this is where the contention zone really took place, and then the market started turning downwards, meaning the buyers gave up resisting the sellers, and the sellers started to push price down. And we can see from the dotted line, this white line right here, where price is right now. We can still see that the buyers have a little bit of force and pressure within the market as they try to reclaim the last candle. Overall, the dynamic between buying and selling is a tug-of-war between thousands to hundreds of thousands to millions of participants, depending upon the asset in question. So from the standpoint of what we see, the stop loss was a beautiful way to control risk. It's guaranteed that we had a limited level of loss. So far, the first trade had a very specific take profit with no limited risk. The second trade that we just did had a very specific risk, as noted, between the price and the red line. But we also had a very specific reward between the price and the green line. So we were able to clearly see our risk and our reward. This is one of the most important pieces of knowledge in trading you will ever have. Understanding the relationship between risk and reward can really help you determine how best to manage your account. you will find a plethora of information all over the web on what people believe is the best ratio of risk versus reward. I don't necessarily believe that is true, because I believe trading is a personal journey. And while having this knowledge can help you, I believe ultimately what is going to be in your best favor, what is going to help you the most, is to find an area of risk and reward that is comfortable for you. The stop loss is a precision tool. I personally don't use it all the time in this way because I believe it limits the flexibility of what the lazy trading approach is. But it cannot be ignored. So let's clean the chart up and then talk about the next trade. Okay, all of the fancy lines are gone and we now have just our candles. We still have the yellow line, or the upper range of the total market I have been tracking for a while now. What I call the resistance zone. Again, it's an arbitrary name, but it helps me understand how the market has been limited and how high it will go in price. So let's look at the current candle, the current market, and decide the trade. We don't necessarily have to take a trade, and that is the important part. We can simply say, the market doesn't look right, and I don't want to trade. The reasons for looking at the market and not wanting to trade is last Friday's candle was an upswing. Today is an upswing. And as we look at the market, there's something to pay attention to that is important and can actually help in the decision-making process on whether or not a good trade is important. And that is looking at the closing price on Friday's candle versus the opening price of today's candle. And then looking at the wicks and seeing just how far the market went between Friday and today so far. We can see through this information that the market is starting to look a lot like what we saw a couple of weeks ago, and that this week might be a big, huge push to the upside. So opening a trade might cause the market to want to actually go higher. But not just because we opened a trade, but because literally thousands of people are thinking similar things and looking at the news, looking at financials, and looking at the possibility of things improving for the euro versus Canadian dollar. So there are reasons not to open a trade. There are reasons to open a trade. And those reasons are profit. The profitability of the market cannot be denied. We are still very close to this range where the yellow line is marked. We still have a very clear area that price doesn't seem to want to go. And if the market does in fact try to do what it did last week and go down a little, it is still a very good opportunity worth trading. It is also possible that we could be looking at what many call an exhaustion event, where the market just might tumble altogether. Let's zoom out and see if we can find a good example of that. Okay, here is a good example of an exhaustion event. We can see here how the market went through that stage, where price just seemed to cascade downward for 4 weeks in a row. So opening a position here and closing it here would have been a very good profit. This is an example of just how well market dynamics play in terms of the back and forth action between buyers and sellers. But this is a situation that could apply to the very market we are looking at today. I say could because it doesn't really matter in terms of what we think. There's simply too many variables to get an accurate prediction or, yes, the market is going to go up. That doesn't exist. And that's how people end up losing their accounts, by getting too confident in a market that is nothing but chaos of thousands of people pushing and pulling against where price is. So let's go back to today's candle and actually look at what we are going to do. So far, I have demonstrated two of Oanda's special abilities. I have demonstrated a take profit order. I have demonstrated a stop loss order. Well, stop loss take profit combination. A full risk versus reward order. Today, I'm going to demonstrate a trailing stop order. And that is an order that will follow price when price goes in our direction. But it could ride the market as far as the market will go to capture as much profit as possible. That is, if we look at the market. If we open a position up here, it could follow the price all the way down to the bottom and capture as much profit as possible. It is a trading technique that a lot of traders really like. It is a stop loss order, so it does limit your losses explicitly. Just like the second order I demonstrated, it has an absolute level of risk that you won't go past very much. So it's an exceptional tool if you want to control your risks. It does have the same problem as any other type of stop loss order. It requires a bit of a precise entry. That precise entry does require a little more technical expertise in getting into the market. Even though it's not something I use on a regular basis, nonetheless, it is something that you should know how to use because it does have a place. It does have a situation where the market can really be quite unique. For example, if you placed an order down here and used a trailing stop, you would have captured, let's try this again. You would have captured all of this profit with absolutely not having to worry about how far the market went up. So it really is an incredible resource. So let's get to the order and talk about it. we're going to do the same that we've been doing. We're going to open a short position for 440 units. And if my chart will stop playing games on me, let's open the sell for 40. So basically we have a $10 position size, which we see right in here, $10.11. Now, unlike the first order we used or the second order we used, we're going to use the third order type, the trailing stop loss. So let's check it. Now, for the trailing stop loss, there's only one line, and that is the stop loss line that will follow the closing price. So stop loss goes up here, and again we're going to go with a $5. Let's get this to roughly $5 of risk. Not quite. Let's see if we can get it closer. It's $4. There we go. $5 of risk. Now notice that our stop loss is above where the market resistance level has been. This is actually perfect because this means we might not be stopped out too soon, and the market will be able to breathe and grow according to what we actually want. This is an example, though, of why you might not want to place an order of this type under certain conditions. If, for example, the stop loss was below a resistance area, you either might want to increase the stop loss, take on more risk, or just not take the trade at all, because that would sign or signify the higher possibility that the market is not in your favor. But right now we can see our stop loss is slightly above where price has not been. So for now, let's take the order. I'm going to submit the order, and we now have a new order. We have the trailing stop loss that as price moves down, it will move down as well. But if price moves up, it does not move. So if price goes upwards, our stop loss, trailing stop loss, acts like a wall. It doesn't move. So it lets us follow the market with no upside, meaning the price could go as far as it wants in the direction we want, and it will follow it. But as soon as the market turns against us, it turns into a wall and doesn't move. So whatever profits we might gain, it tries to protect as much as possible within this level of risk. $5 worth for our examples of our risk. If you put this too close, just like a regular stop loss, you could be stopped out prematurely and end up losing money on a winning trade. This is a precision tool just like a traditional stop loss. But it allows your winners to run. So if you really think you have a situation where the market just looks exhausted or it's ready to rally and you want to go in that direction, this is an exceptional way just to let the market have a field day while trying to protect whatever profits you capture along the way. So now that we have our third trade, we simply wait and watch and see how it turns out. Later on, I will put lines on it like I did yesterday, and throughout the course of the trade, I will follow price and the moving of the stop loss as it trails down, so we can see exactly what that looks like from the beginning to the end of this trade. Please give this video a thumbs up if you liked it. Please share your thoughts and let me know what you think of the process. I look forward to reading your thoughts. Thank you for watching, and until next time.